Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks, finance, and risk management. I'm your host, Lewis, and I'm excited to have you join me today as we explore the latest developments in the financial markets. We're starting off with a story that's been making waves in recent days: the growing concern over government debt stress and its potential impact on global markets. From Britain to Japan, and even here in the United States, there are fears about the sustainability of public finances. And as bond yields rise, investors are bracing themselves for a potential ripple effect across various assets, including big tech, housing, and currencies. Now, let's take a closer look at what's happening. In Europe, French budget tumult is weighing on European stocks, which have lagged behind the global index since June. Meanwhile, in Japan, surging inflation and speculation about a potential rate hike by the Bank of Japan has helped lift the yen against the dollar. And here in the US, ballooning government debt has sapped demand for lending long-term to governments. So, what does this mean for investors? Well, some are preparing for stress to spread across assets, while others see opportunities in the midst of uncertainty. For example, RBC Blue Bay Asset Management's fixed income CIO Mark Dowding is betting against the British pound, citing concerns about the country's fiscal troubles. On the other hand, Artemis's head of investments, Toby Gibb, is topping up on Japanese equities, expecting domestic money to flow into domestic stocks. As we navigate these complex and interconnected markets, it's essential to remain vigilant and adaptable. We'll be keeping a close eye on developments and bringing you expert insights and analysis to help you make informed decisions. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. I'm your host, Lewis, and we're glad you're still with us as we dive into the world of finance and economics. In this segment, we'll be discussing a significant development in the alternative asset management space. Mount Logan Capital Inc., a company focused on public and private debt securities in North America, has announced a strategic move that's caught our attention. Now, let's get down to business. Mount Logan Capital Inc. has completed a deal with 180 Degree Capital, and as a result, it will be listed on the NASDAQ under the ticker symbol MLCI. This is a big step for the company, which aims to provide attractive risk-adjusted returns to its investors through its investments in loans, debt securities, and other credit-oriented instruments. As we take a closer look at Mount Logan's portfolio, we notice that it has a unique approach to managing risk. The company has a diversified portfolio of assets, including collateralized loan obligations and reinsurance of annuity products. Its indirect, wholly owned subsidiary, Ability Insurance Company, is also an interesting aspect of its business, as it reinsures long-term care policies with largely reinsured morbidity risk. Now, I know some of our listeners might be thinking, what does this mean for investors? Well, let me tell you. This deal has the potential to provide Mount Logan with more visibility and access to a broader range of investors. This could lead to increased liquidity and potentially lower costs of capital, which would be beneficial for the company's growth plans. However, as with any investment, there are risks involved. The company's forward-looking statements do come with some caveats, and it's essential to carefully review the reports filed with the SEC and SEDR+ to get a comprehensive understanding of the potential risks and rewards. In conclusion, Mount Logan Capital Inc.'s strategic move is an interesting development in the alternative asset management space. While there are potential benefits, it's crucial to approach this investment with a critical eye and consider all the factors involved. As always, we encourage our listeners to do their own research and consult with financial experts before making any investment decisions. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We've got a thrilling update for you on the world of cryptocurrency, specifically focusing on XRP and its recent price movements. It appears that XRP has formed a tight range between 3x10 and 3x07, with analysts anticipating a potential breakout as the triangle pattern nears resolution. This development comes on the heels of heavy institutional inflows, which pushed volume 4 times above daily averages on September 11. The token advanced nearly 2% to close near 305, defending support at 298 before testing resistance around 307. Now, let's dive into the details. Ripple has strengthened its partnership with Spanish banking giant BBVA to deliver digital asset custody solutions under the EU's MiCA framework. This move is expected to bolster institutional legitimacy and potentially impact XRP's price stability. Additionally, futures open interest in XRP climbed to 836 billion, reflecting leveraged positioning ahead of potential ETF-related announcements. However, it's essential to note that whale wallets have accumulated 340M XRP tokens in recent weeks, while exchange inventories reached one-year highs. This raises questions about near-term distribution pressure and the potential for volatility. From a technical analysis perspective, support is anchored at 2298, validated by outsized buying volumes. Resistance is concentrated between $32.05 and $32.07, where repeated rejections occurred. The descending triangle formation tightening around the 3.02.07 corridor points to imminent breakout resolution. As traders watch for a potential breakout above 307, they're also keeping an eye on exchange reserves rising to 12-month highs, which could be a warning sign of distribution pressure if whale inflows stall. The impact of Ripple's expanded BBVA partnership under MiCA and macro signals from central bank rate decisions will also play a role in determining XRP's next move. In conclusion, the situation with XRP is complex and multifaceted. While there are signs of institutional interest and potential for growth, there are also warnings of distribution pressure and volatility. As always, it's crucial to approach investing with caution and consider multiple perspectives before making any decisions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, keep your finances in check.